Over the past couple of weeks, we've talked about how income tax and national insurance work. For those of us who are building wealth, the logical next step is to look to save some money by using some valuable reliefs. Okay, let me first say that I really do think tax is a good thing. Clearly, it's necessary for any developed economy to have a robust and healthy tax system. You know, it pays for the roads and the hospitals and the schools and stuff. So I'm in favor of tax, okay? But I'm also in favor of making use of any reliefs that are available. We need to be under no illusion. Any government that offers tax reliefs is making more tax somewhere else in the system. So if you get a relief for investing, say, in a venture capital trust, you're investing in a young startup company, by doing so, that company will grow, hopefully, pay more corporation tax. It'll employ more people who will pay more income tax and national insurance, who will buy more stuff and hence pay VAT. So you're getting a saving at one end, but on the other parts of the tax system, chances are the revenue is making even more money thanks to your investment. Of course, it's incredibly complex and nuanced and intertwined. I don't begin to understand it, but let's not be afraid of using these reliefs. They're there for a reason, as an incentive to save. So specifically, I want to talk about income tax relief and salary sacrifice. So let's put 5 minutes on the clock and say thank you to my friends at 7 Investment Management for continuing to sponsor the show, and let's crack on. Okay, so let's talk about tax relief first and focus primarily on pensions. So we talked about how we get taxed on our income a couple of weeks ago, and yet the government gives you some of that tax back notionally when you make a pension contribution. So this happens in one of two ways. If you're an employee, usually you pay your pension contribution off your gross salary and then get taxed on what's left. So if you make a £100 pension contribution, you're essentially earning £100 less, and therefore you pay less tax. You pay either 20% or 40% tax, depending on whether you're a basic or a higher rate payer. And so if you think about it, because you haven't paid that tax when you otherwise would, you can consider it that HMRC is putting that money into your pension for you. They haven't actually paid it to you, they just haven't asked you to pay it. So you have saved that tax and instead put the money into your pension. The alternative, of course, which sometimes happens for employees and always happens if you make a personal contribution outside of your PAYE system at work, if you're self-employed or whatever, is that you pay the net amount into the pension, net of basic rate tax, that is. So you might pay £80 into your pension, and then the pension company goes to the HMRC and says, please pay us the tax relief. And that usually happens within a couple of weeks. So you put £80 in and £20 comes back from the taxman, making your pension contribution up to £100 gross. Worth mentioning, by the way, that somebody in the Facebook group discovered that the platform that they were using wasn't investing the money when it came in from HMRC. So their own contributions were being invested, but the tax relief wasn't. It was sitting in cash. So that's something to check. Now, if you're a higher rate taxpayer, you also put on your tax return that you have made a gross contribution of £100, and HMRC will reduce your tax bill by another £20, another 20% on that £100 pension contribution. So if you think that through, £100 has gone into your pension, but it's actually only cost you £60. £40 has come from tax relief, 20 of it direct into your pension, and 20 of it by a reduction in your tax bill. Pretty useful. So all these things really are ways of redirecting money from the taxman into your pension. It's in your hands rather than his. And that's got to be a good thing, right? You can get tax relief from other sources too, not just pensions, venture capital trusts, they're called VCTs, enterprise investment schemes, EISs. These offer income tax relief as well. Now you pay the full amount into your investment, so let's just call it £10,000, make it easy, and you put on your tax return that you have made that contribution. You will also get a certificate from the investment provider to prove that you've made that contribution, and then the taxman will reduce your tax bill by 30% of the investment you've made. So if you put a £10,000 contribution into a VCT, then you will get £3,000 back off your tax bill. So again, HMRC are not giving you that money as such. You've paid the 10,000 quid into the investment. You wrote the check for that, but your tax bill is reduced by the 3,000. So the net benefit to you is that you've got 10 grand in investment, which has only cost you 7. So all these things are just essentially ways of redirecting money that would otherwise be paid in tax into your bin. So whether it's in your pension or VCT or whatever, it's money that is in your hands rather than the tax man's, and that's got to be a good thing. Tax person. Okay, the other really useful option is salary sacrifice. Now this of course assumes you have a salary. You need to be employed. So what happens here, as the name suggests, is that you give up, you sacrifice a portion of your salary and instead ask your employer to pay that into your pension. So you might say to your employer, right, I want you to pay me £10,000 less and instead put that £10,000 directly into my pension pot. So let's think about what's happening here then. Your salary has been reduced by £10,000, so you're earning 10 grand less and hence paying less income tax. But actually what's happening is that income tax is being redirected into your pension, of course, as part of the £10,000. And because your salary has reduced, the employer now has less national insurance to pay. Remember, we talked about employers' national insurance last week. And so what many employers do is offer to pay some or all of that national insurance saving into your pension for you. So that's a valuable added benefit. It's more free money going into your pension pot. And because your salary is reduced, you will pay less personal national insurance. So that has a beneficial impact on your take-home pay. And what you might find is that your take-home pay is better than you think it might be, having given up 10 grand of your salary. So you need to check with your employer, firstly, if they will do it for you and what form it will take. You can ask them what your take-home pay would look like if you were, for example, to give up £5,000 worth of income and put it in a pension, or 10,000 or 25 or whatever. Need to be careful because very often you have to agree to sacrifice your salary for a full year. You can't sort of do it for 2 months and then see how you get on. Very often you have to contract for a year that you will sacrifice that salary. So make sure you don't leave yourself short. You also need to check the interplay with things like the pension annual allowance. You don't want to fall foul of the rules there when it comes to calculating the tapered pension annual allowance for high earners. Salary sacrifice is taken into account in the calculations for that. So be careful. Seek professional financial advice or accountant's advice if you're not sure about all that stuff. There are some other disadvantages of salary sacrifice you need to be aware of. If you have death in service life cover offered by your employer, if you've reduced your salary, then maybe the benefits from the death in service plan will be reduced as well. You need to check that. Normally, if you join a final salary defined benefit pension scheme and you leave within the first 2 years, you can get a refund of your contributions. However, under salary sacrifice, you haven't technically made the contributions. They are employer contributions. You've sacrificed the money and asked the employer to pay it into the scheme themselves. Technically, that's an employer contribution, and probably you won't get a refund of that if you leave the scheme within the first 2 years. Something to be aware of. Obviously, if you're giving up salary, then salary multiples and affordability calculations for borrowing on a mortgage will be affected. So if you're thinking of moving house or changing your mortgage in the near future, that's definitely something to be aware of. And finally, there might be impact on some other benefits such as statutory maternity pay and stuff like that. So as ever with this, you need to go to your employer, just ask them how the scheme works, ask them to tell you what the impact will be on your take-home pay and on any other issues that we've talked about, but definitely consider it. It's a valuable benefit and a useful little relief. Okay, hope that helps. Hope that makes sense. Hope you enjoyed it. Have a great weekend. I'll see you in next week's 5 Minute Friday.